The market often gives the speculator the correct signal. The position moves instantly into the profit column. This initial success breeds a powerful anxiety. The novice begins to fear the loss of his paper gains. He watches the tape with growing nervousness. He sees 3 points of profit and decides that is enough. He closes the trade immediately. This is a profound error of judgment. He allowed fright to dictate the exit point. The market intended to deliver 30 points, but the speculator surrendered the position early. The professional trader knows that price is only an effect. The true cause lies in the law of vibration. Time controls all market movements. The trade must be held until the controlling time factor is fulfilled. The profit target is fixed by this calculation, not by temporary price fluctuations. Violation of this rule destroys confidence. The speculator begins to doubt the validity of the underlying plan. He attempts to recover the points he abandoned. He enters into reckless overtrading. He loses the mental discipline required to hold a perfect position. The trade must run its course. The true speculator waits for the completion of the time cycle. He does not exit until the clock itself dictates the final price. The amateur speculator often determines his risk based on greed. This is a fatal flaw. The true professional knows that risk must be a fixed percentage. Before we continue and get to the main point, I'd like to thank you for the interaction that drives this content. If possible, take a second to subscribe, like the video if you enjoy it, and leave a comment. This helps the video reach more people, especially your subscriptions, and guarantees you won't miss the next breakdown. The market demands preparation. It rewards study. The speculator often ignores the past. He seeks novelty. This is a profound mistake. The tape records everything. History repeats itself relentlessly. The foundation of real success is built on understanding timeless laws. One man devoted his life to observing these laws. He studied price and time with relentless discipline. That man was William Delbert Gann. He committed his understanding to paper. He described the underlying structure of market movement. This work is known as Truth of the Stock Tape. This is not a book meant to be skimmed or summarized. Modern interpretations often dilute the message. They miss the underlying geometry and discipline. The real value lies in the original thinking itself. The book explains how price and time interact, how markets move in cycles, and why most traders fail to wait. This text is essential reading for anyone who takes speculation seriously. It replaces guesswork with structure and impulse with understanding. Do not trade blindly. Study the principles laid down by those who learned directly from the market itself. The book is available through the link in the description below. 10% of the capital is the limit for any single commitment. This is the first rule. Many fail it before the trade even opens. They employ funds allocated to other ventures. This causes mental friction immediately. Fear arrives precisely when the speculator needs calm detachment. The size of the position cannot be determined by the wish for profit. It is a strict mechanical calculation. The distance to the defined stop-loss dictates the number of shares. Every commitment demands a protective stop. This stop is not placed arbitrarily. It is mandated by the underlying calculation. This is Gann's third unbreakable rule. The stop must reside strategically below the designated angle of support. This is often the critical 45-degree line. A break of this line invalidates the entire time cycle analysis. Failure to follow this eliminates mental detachment entirely. A natural reaction or shakeout causes panic. The speculator reacts to the noise, not the chart's geometry. The price and time targets must be defined long before the entry. The stop-loss is positioned only where the underlying calculation is demonstrably invalid. This mechanical discipline ensures the trader is protected by his own arithmetic. He is not exposed to the fickle nature of his own emotions. He knows exactly what the market must do to prove him wrong. The average speculator enters the game without proper maps. He acts on impulse or rumor, not on calculation. He lacks the essential knowledge of natural resistance points. The market moves against him, but he never knew where it was supposed to stop. The skilled mechanic understands that price and time must be brought into balance. This is the absolute necessity of squaring the range. It is a precise geometric calculation that must be done first. It defines the natural limits of the current movement. The chart must reveal critical time counts. These are points where the vibration changes. Targets such as 90 or 360 days are not arbitrary selections. They are derived from the circle and the division of the whole. The 1-by-1 angle is the measure of the trend's health. It represents the 45-degree line of ascent. A truly perfect trade holds steady above this crucial angle. The trend is sound while that balance remains intact. When the market experiences a natural secondary reaction, the unprepared trader panics. He sees the price drop and believes the trend has broken entirely. He does not realize the market is merely testing the strength of the 1-by-1 angle. He exits his profitable position too soon because he cannot distinguish a test from a reversal. His lack of geometry costs him the major profit. He sold his stock back to the stronger hands. The geometric framework prevents this emotional error. It requires reliance on the sound chart, not the anxiety of the moment. Without this structure, the speculator is exposed to hope and fear. He must rely absolutely on the squared chart. The time factor dictates the proper holding period. The arithmetic must always rule the imagination. The trade is held until the geometry fails. The market always tests the speculator. It attempts to shake the position free. This reaction is a natural occurrence. It works off the excess enthusiasm built during the initial thrust. The professional understands this inevitable action. He looks immediately to the calculated geometry. The trade must be measured against the controlling angle. This is the crucial test of mental discipline. A strong advance often reacts sharply. It might fall back to the 2-by-1 line. That level often provides temporary support. The angle predicts the necessary limit for this counter-trend move. The real danger appears when the market approaches the 1-by-1 angle. This line represents the main trend support. The speculator holds the position only as long as the price remains above this crucial line. Should the price close below the 1-by-1, the entire geometry is broken. The time cycle may require immediate reassessment. Until that closing break occurs, the trade remains structurally sound. Many smaller traders fail at this exact juncture. They see the sharp drop and panic. They forget the arithmetic that governed the original entry. The fear of losing profit overwhelms calculation. They sell their perfect position into the reaction. This frequently happens near a critical reversal point. The 7/8 division often causes these sharp, sudden tests. The speculator sells the low, violating the 9th rule of trading. The proper discipline is simple but difficult to maintain. Trust the calculated angle absolutely. The angle defines the precise limit of the natural reaction. If the geometry holds, the time factor remains intact. The trader must simply wait for the calculated time target. Pyramiding is often misunderstood by the novice. He sees it as a way to compensate for earlier mistakes. This is a fatal error in judgment. The speculator must reserve new commitments only for trades already showing profit. Pyramiding is the reward for correct discipline. It is not a tool for rescue. Rule 12 outlines this strategy precisely. New purchases must be progressively smaller than the previous position. This discipline is rigid and mandatory. The trader must keep the average entry price far below the current market price. This low average is the ultimate protection. It guarantees a low risk profile for the entire position. New entries are never made on a whim. The market must offer mechanical confirmation. This confirmation arrives when the price breaks a major angle of resistance. The break confirms the initiation of the next calculated leg. It validates the ongoing time cycle calculation. The trader then acts, but only with reduced size. Failure to adhere to Rule 12 compromises everything. It transforms a sound speculation into a highly leveraged gamble. The market never forgives this kind of greed. The solution is mechanical and straightforward. The trader must use existing paper profit to finance the new commitments. This keeps the initial capital protected. The total risk on the accumulated position must remain within strict limits. It must never exceed 10% of the total trading capital. This risk management rule is unbreakable. The market tests conviction constantly. The speculator must view pyramiding as a tool of patience. It is the disciplined method of holding a perfect trade to its final time target. The speculator faces an enemy greater than the market itself. This enemy resides within the confines of the trading room. It is the human element of hope and fear. Hope enters when a position moves against the initial entry price. It whispers that the trend will change soon. This false counselor encourages holding on to losses too long. It violates the basic rule of cutting losses quickly. Fear arrives when paper profits accumulate heavily. The speculator then worries about losing what has been gained. This panic causes premature liquidation. It forces the trader to sell out before the time target is reached. This is a common violation of Rule 16. Successful speculation cannot tolerate these emotional swings. The operation must be purely mechanical. It must be dictated solely by fixed laws of price and time. The speculator must achieve complete detachment. The monetary value involved should not influence the decision. The system demands total fidelity to the plan. Rule 17 requires ignoring all outside opinions and chatter. The news and the crowd are never reliable guides. The speculator must enforce this necessary isolation. The true guide is the geometry of the square. It reveals the exact points where price and time meet. The laws governing the market are immutable, like mathematics. The structure must be trusted completely. Emotional trading always leads to maximum regret. The undisciplined trader sells at the reaction low. They buy back the position at the reaction high. They suffer the maximum penalty for lack of faith in the method. Trading is a serious business governed by mathematical laws, not feelings. The ultimate achievement is self-control, Rule 24. This ability allows the execution of the entire system flawlessly. It is the discipline required to hold the perfect trade to its final conclusion. The most difficult task is holding the position. The speculator often watches a massive profit accumulate. Satisfaction sets in too early. That feeling of wealth is dangerous. The trader mistakes a price target for the final completion. The market is governed by time. Time is the controlling factor in the final move. Price may satisfy the projection weeks before the calendar date. The stock simply consolidates then. It waits for the time count to fulfill itself. The law of vibration demands synchronicity. The greatest peaks occur when time and price coincide exactly. The speculator must know the cycle dates in advance. Look for the completion of the circle. This often means 360 days from the important reversal low. That represents the full degree movement of the calendar. The position must be held until that final date. Exiting prematurely forfeits the most dynamic segment of the move. That last acceleration generates the largest profit. It is the reward for perfect patience. Discipline means absolute adherence to the mathematical projection. The trader must sell only when the calculation is fulfilled. Price action is secondary until the time factor is satisfied. Once the calculated time count has been reached, the market gives the final signal. The ultimate exit trigger is the failure to hold the one-by-one angle. The stock must break below that supporting line. That failure confirms the cycle is complete. Holding the trade past the price target requires immense self-control. The market often tests the trader's resolve during the consolidation period. That sideways action causes doubt. The perfect trade is held to the final conclusion. It is held until the clock ticks down and the one-by-one angle is broken. That is how the maximum penalty is avoided. The speculator must trust the geometry of the market. The system protects those who follow the rules without deviation. The system demands total obedience. The 24 rules form an unbreakable chain. A speculator cannot choose only the convenient parts. Selective adherence guarantees ruin in the end. The market rewards mechanical consistency. Rule 24 is the final mandate. It requires the absolute mastery of the self. The successful trader must eliminate fear and hope entirely. These elements are introduced only by violating a preceding rule. Discipline is the highest form of professional armor. The true professional acts like a machine. The plan is derived from the geometry of the square and the angle. He executes that plan without question. He trusts the fixed laws of repetition. The position must be held to the calculated time target. This is the ultimate proof of commitment. Any single violation destroys the integrity of the trade. It introduces the poisonous element of human doubt. The speculator must wait patiently. The market always fulfills its geometric promise. Trust the time factor. Hold the perfect trade until the clock ticks down. Do not interfere with the inevitable.